Okay, let's unpack this. Imagine hearing a story, right? Someone starts with just like $13,000,
Yeah.
and somehow they end up with a massive $153 million. Your brain probably just stops. You think, hang on, is that even remotely possible?
It sounds completely unbelievable, doesn't it? Like something out of a finance fairy tale, almost.
Absolutely. And, that initial shock, that's exactly what hooked us when we were uh, digging into some source material about, well, legendary traders. Amidst all the names you might expect, one just jumped out with these numbers that seemed, well, too wild to be true. Takashi Kotegawa.
Yes, the bedroom trader.
Exactly.
Yeah.
He got that nickname because, get this, he supposedly pulled off these incredible financial feats right from his own home.
The headline number is definitely the shiny object. It grabs you. But as always with these deep dives we do, our mission isn't just to repeat that big flashy claim. We want to get behind it, you know? Use the source material you shared to figure out how this seemingly impossible thing actually happened according to the information we have.
Right. And see what, if any, actual usable insights we can maybe pull out for you, the listener.
Precisely.
Okay, so let's start by just anchoring ourselves in those mind-blowing figures again. The source material does confirm the core claim,
Right.
$13,000 somehow. Well, it blossomed into $153 million.
Mm-hmm.
And for a bit more context, the article even did a quick translation using an approximate rate of 85 Indian rupees to the dollar.
Yeah, that puts the initial $13,000 at around, what, 11 lakh rupees, give or take?
Okay, 11 lakh. And the final number, that colossal $153 million.
That ends up being roughly 1,300 crore rupees,
It's 1,300 crore.
11 lakh. The 1,300 crore. Just saying those numbers back to back makes your head spin.
Really.
And the source itself kind of mirrors that disbelief we all feel. It explicitly asks, is it really possible? Can anyone actually do this?
And that question is so critical because the journey to that 1,300 crore wasn't quite what that simple headline might make you think.
No, not at all. That's a really crucial distinction to make up front. While he did trade for many years after, the origin story of a huge chunk of his starting capital, well, it came from a single, totally bizarre event. This wasn't built from scratch, using just skill on that initial 11 lakh, not even close.
Right. And this is where the story takes a turn towards the, frankly, unbelievable.
Yep.
We have to talk about what the source calls the JCOM jackpot. This all went down back in 2005.
2005.
It centered around the IPO, the initial public offering of this Japanese company, JCOM Holdings.
Now, you need to understand, a single share of JCOM Holdings was pretty pricey, trading at 610,000 yen.
Wow.
Yeah. The source gives a useful comparison for maybe listeners familiar with the Indian market, pointing to a stock like MRF, known for having a really high price per share, like 108,000 rupees in their example.
Okay, so we're talking about a stock where buying just one share is a significant investment.
Exactly, a big commitment for one share.
Got it. Very expensive share. Now, here's where disaster met opportunity. A trader working at a big brokerage firm, Mizuho Securities,
Great.
intended to sell just one share of JCOM at its correct high price, 610,000 yen. Simple enough order, right? Should be easy.
Should be. Except in what's now become this legendary fat finger error. I mean, literally a mistyped order. They accidentally placed an order to sell, wait for it, 610,000 shares.
610,000 share.
For just 1 yen each.
No. So they meant one share for 610,000 yen, but they offered 610,000 shares for 1 single yen each.
Exactly. The mind just boggles.
That's insane. It's like that MRF analogy you mentioned, meaning to sell one MRF share for, say, 1 lakh rupees, but accidentally putting in an order to sell a whole lakh of shares for just 1 rupee each.
You can almost picture the sheer panic at Mizuho Securities when they realized.
Oh, absolutely.
So this mistake, this catastrophic error, created this unbelievable, momentary glitch in the system. A tiny window to buy something for basically nothing that was actually worth a fortune.
And our bedroom trader, Takashi Kotegawa, he was online, saw this flash up, and was quick enough to just pounce.
He did more than just see it. He acted fast. He
Right.
bought 7 of 100 of those shares at that ridiculously low, totally wrong price.
7,000 shares at 1 yen.
Okay. And from that single trade, just exploiting that massive error, the source says he made an immediate huge profit, around 17 million. Presumably that's converting from yen pretty quickly.
Wow.
Yeah, he apparently booked a chunk of it right away, instantly turned almost nothing into this huge sum of money, and it was based purely on spotting and reacting to someone else's catastrophic mistake.
And the source material is really, really clear about this part. It calls it a fluke. right? A shock,
Mm.
a snap.
Mm-hmm.
It explicitly underlines that this kind of massive market error happening to you, the average trader listening today, it's impossible.
Yeah, don't hold your breath waiting for that.
Right. So this enormous initial gain, this giant leap forward, it wasn't the result of his amazing trading skill built up over years. It was the direct outcome of a 1 in a million market operational screw up.
Exactly. But what's fascinating here, and this is the part often glossed over in just the headline, that full $153 million figure didn't just magically appear from that one mistake.
Ah, okay.
That roughly 17 million gain from the JCOM fluke, it gave him substantial starting capital, a massive head start, you could say, which he then took and proceeded to grow over the next 8 years through his actual day-to-day trading activities.
Okay, right. So the JCOM thing was like the rocket fuel, as you said. It got him off the ground in a way almost no one else ever could.
Pretty much.
But the 8 years after that, that's where his actual trading strategy and presumably his skill comes into play.
Right.
So how did he navigate the markets during that time? What did the research find?
Well, the source indicates he has a distinct preference. He actually seems to enjoy trading the bear market more than the
Right.
bull market.
Well, that's interesting.
Yeah. A bear market, just quickly for anyone unsure, is when the market overall is falling or expected to fall quite a bit. Most traders find that pretty challenging, right?
Definitely. It's usually seen as harder.
But he seems to thrive in that environment, looking for opportunities specifically when prices are
A
dropping.
bit of a contrarian then.
Oh, wow.
So, okay, he likes falling markets. Within that preference, what were the specifics? Did the research uncover details of his strategy?
It seems he relies quite heavily on technical analysis, chart patterns, indicators, that sort of thing.
Okay.
A key indicator mentioned is the 25-day exponential moving average, the EMA.
Right, the 25 EMA. Pretty common tool.
Yep. Think of it like a line on a price chart showing the average price over the last 25 days, but it gives more weight to the most recent prices, so it reacts a bit faster.
Got it. Smooths out the noise, shows recent trend. How does he use it?
He looks for individual stocks that have fallen really sharply. Specifically, the source says stocks trading around 20% or maybe even 30% or more below their 25-day EMA line.
Wow, that's a significant drop below the average.
It is. He's looking for extreme weakness.
And he's hunting for this kind of setup, a stock way down from its recent average, mainly during a bear market, when lots of stocks are declining anyway.
Exactly. It's like looking for the weakest fish in an already draining pond, maybe?
Yeah.
Looking for that extreme oversold condition within a generally weak market.
Okay, makes sense. Is that the whole signal? Or is there more?
There's a bit more. As a sort of confirmation, before jumping into a trade, the source mentions he also uses the max CD indicator.
Ah, AppCD, another popular one for momentum.
Right. Moving average convergence, divergence. Traders use it to gauge momentum, potential trend changes.
Yeah.
He reportedly looks for a specific signal called a crossover on the AppCD.
Okay.
And often he's looking for this crossover on a shorter time frame chart, like maybe a 15-minute chart, as a kind of final, okay, maybe now, signal.
Oh, so let me see if I got this. The basic signal is stock is trading way, way below its 25-day average,
Yeah, like 20% plus below.
especially during a bear market overall. Plus, you get a momentum confirmation, like a Mackie crossover on a short-term chart.
Mm-hmm.
And presumably, this is happening near a price level where the stock might find some support, like a level where buyers might step in.
Yes, that seems to be the idea. That combination of signals suggests he's trying to time an entry point to catch a short-term bounce, after a really steep fall.
Makes sense. Trying to catch a falling knife, but with some technical rules.
Kind of, yeah. The source also notes he likely uses stock scanners, software tools that can quickly sift through the whole market.
To find stocks meeting those criteria, like show me stocks 20% below their 25 EMA.
Exactly. They even showed an example from a scanner in the material indicating that in the current market conditions when they wrote it, actually finding stocks that far below their 25-day EMA was pretty rare.
Right. Which reinforces that this specific setup is really for particular market environments, probably significant downturns, which aligns with his preference for bear markets.
Precisely. It's not an everyday strategy.
The source did mention, though, didn't it, that some crucial details about his exact method weren't easily found online.
That's right. Things like, how did he choose which stocks to apply this to? Was there a fundamental analysis layer? We don't know from the source.
Or his precise stop-loss strategy, like how did he define his risk and get out if the bounce didn't happen?
Yeah, that wasn't clear. Or his target risk-reward ratio, was he aiming for 1.3, like some suggest, or something else? Those specifics are missing from the public info trail, it seems.
Okay, so we have the core technical setup, but not the complete trading plan blueprint.
Correct. But we can infer the likely goal. The expected outcome of using the specific technical strategy would probably be to capture a quick, short-term move back upwards.
Like aiming for maybe a 10% bounce back towards where the stock was trading before the big drop.
Something like that, yeah. A reversion to the mean trade, essentially, after an extreme move down.
And it's really crucial to remember, I think, as the source implies. Even with a strategy like this, it's highly unlikely he was profitable on every single trade, especially in a falling market.
Oh, absolutely not. No trader is.
Getting from that initial 17 million, even with that huge head start, all the way to 153 million over 8 years. I mean, that suggests consistent application of his strategy across many trades.
Writing out the inevitable losses, managing risk, and letting the winners, well, hopefully run enough to compound those gains over time. It's the grind after the fluke.
So, okay, if we boil it all down,
Hmm.
what's the real story here? Behind the legend of the bedroom trader and his jackpot, based on this deep dive into the sources.
Well, it really feels like a two-act play, doesn't it?
Yeah, I think that's a good way to put it. Act
Yeah.
one.
Act one, an initial, absolutely enormous capital injection resulting from an almost unbelievable, certainly unreproducible market operational error, the JCOM incident.
Which was pure, extreme, dumb luck, right place, right time, fast fingers maybe.
Couldn't have planned it in Act two.
Act two is the subsequent, still very impressive, significant growth of that lucky starting capital, but over a long period, 8 years. And that growth came through a consistent application of a disciplined trading strategy, one focused mainly on identifying and trying to profit from those sharp price dips in individual stocks during bear markets.
Using those specific technical signals we talked about, like the 25-day EMA and the Emishidi confirmation, skill and discipline applied after the luck.
And the source material's final conclusion really hammers this home, I think.
Yeah.
It emphasizes that the initial headline-grabbing profit, the thing that makes the story sound so impossible,
Was down to that fluke, that error that, as they say, won't happen again for you or me.
exactly. So while Kotegawa clearly is a successful trader, you don't turn 17 million into 153 million over 8 years by accident. The source kind of suggests that his story, well, precisely because it started with that insane lucky break.
It might paradoxically be less instructive, less relatable, maybe even from a pure trading strategy perspective, less interesting than the stories of other top traders who built their fortunes purely through skill and discipline from more, let's say, normal starting points.
Right. Which is maybe why this deep dive matters for you. Listening now, that simple narrative, 13K to 153 ounces, it's incredibly powerful, grabs your attention.
But without understanding the context, the source material provides that initial impossible fluke, then followed by years of grinding out returns using a specific niche strategy, you miss the real picture.
Yeah, you don't see that stark contrast between the accidental jackpot and the long-term strategic effort that had to follow to build upon it.
Which leaves us with a pretty interesting thought to chew on, I think.
Yeah.
Well, in these really volatile, uncertain fields like trading, how do we weigh the roles of just extraordinary, unpredictable luck versus consistent strategic effort when we see these outlier successes?
Good question. Does a story like Kotegawa's, where someone brilliantly capitalized on a massive fluke and then used strategy to build immense wealth, does that change how you think about success compared to someone who, built their fortune purely from strategic trading right from day one, maybe starting with a much smaller non-fluke amount?
There's one more impressive, or just
Something different.
something definitely worth pondering as you process this deep dive.